Electric vehicle stocks crashed again on Monday, and this time the reason was over the weekend we found out that Tesla and BYD are going to be giving up to $5,000 of incentives to customers in China. And this is just another continuation of the price war that has been happening around the world, led by Tesla in the US, reducing prices starting in December 2022. And then there's been a number of manufacturers in China that have been doing the same, really causing Tesla to respond to the price pressure there. So this is something that we've seen coming from a mile away. I've been covering this on this channel since December of 2022, that this is fundamentally a manufacturing business. Electric vehicle manufacturers are not technology companies. They should not be expected to have technology margins. They should not be trading at technology multiples, and they have manufacturing risks. That's the biggest risks to their business, and that's exactly what investors are apparently figuring out right now. Is that once you have too much supply in the market and not enough demand, the only way for these companies to logically respond is just to lower their prices and eat away at their margins until somebody fails and somebody gives up. And I think the worry for investors right now is that we don't know exactly who is going to win this battle. I think Tesla is obviously in the best position. They're still free cash flow positive. They still have the manufacturing scale that nobody else has. But if you look at other companies like Rivian, like Lucid, like Fisker, I could go on down the line. A lot of these companies are in really, really rough financial position. We should start questioning whether or not they can survive. That's the fundamental question for them right now. Tesla's a little bit different because Tesla is more of a valuation question. Is it worth paying what we're paying for Tesla right now from a stock market perspective? But first I want to get to the survival question, because that's really what we need to think about with a lot of these companies, because this is a downward spiral that we're in. This happens in the manufacturing business. So if you haven't been following manufacturing for a long time, I think this is something to pay attention to. Once margins start to fall and losses start to mount, now you have to finance those losses. How are you going to finance those losses? There's really only two options when your core business is not generating cash. Your two options are you sell stock or you sell debt. When your stock price starts to fall, it gets more expensive to raise debt. We've seen that with Rivian. Rivian's debt is over 10%, just a very expensive interest rate to be paying for debt. And now the stock price is falling. It's down over 90% from its peak. So if Rivian is going to raise cash, let's say they need to raise a couple $1 billion, the market cap is getting close to $10 billion right now. If there's a dilutive stock offering that's going to be 10, 20% of the shares outstanding, the stock is going to fall again another 10 to 20%. That's going to make it even more dilutive. That's going to even make it even harder to raise capital. And now customers are going to be worried about, are these companies going to be able to survive? Is it going to be risky buying a Rivian vehicle or a Lucid vehicle or a Fisker vehicle? That hurts your sales and your margins, which causes your stock price to fall. Like I said, downward spiral, and none of these things are good right now. We have seen this before in manufacturing. I have watched this take place and made a lot of mistakes during the downfall of a lot of the solar manufacturers, where the same exact thing happened. A lot of Chinese suppliers came into the market. They had lower costs and arguably better technology than a lot of their US competitors. US competitors ultimately had to respond by lowering their prices, which hurt margins, which eventually led to losses on their manufacturing plants that they were built. Now, meanwhile, your technology is improving, so you have to build the next manufacturing plant to keep up. And it's just this treadmill that companies weren't able to keep up with. Most of the companies, whether it's Chinese companies or US companies, filed for bankruptcy over the next few years in the solar industry. And I think the same exact thing is going to happen in the electric vehicle industry. We don't know exactly what companies those are going to be today, but if you're an EV investor, you need to know the risks that are happening right before our eyes in the industry right now. That was a lot of background, but I think it's important to have some historical context to what's going on in EVs right now. My name's Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's just go through the stock prices and then some of the margins and cash flow numbers for some of these companies to just show exactly how challenging this is getting. The first company I'm going to look at is Rivian, and this is a chart of the company's market cap. I think that's much more important right now than the company's stock price. But just for context, as I'm recording, the market cap for the company is about $10.7 billion. So that's the valuation for the company. But let's bring a couple of other things into this. And the first is cash and debt. You can see at the end of 2023, there was about $9.4 billion worth of cash and about $4.4 billion worth of debt. So on the surface, that looks like a reasonably strong balance sheet. But the problem for Rivian is they're not cash flow positive. In fact, in the past year, they burned $5.9 billion worth of cash. So the trends are negative. Not only are they burning cash from operations, they're also burning cash building out the next generation manufacturing plant that would be in Georgia for the R2 vehicle. So what management expects for 2024 is production to be about flat. I think that was a real warning sign, and I covered that on this channel, that they're only going to produce as many vehicles as they did last year, indicating there's probably not enough demand for their vehicles. So they're making some upgrades to help lower costs long term. But if they were swimming in supply, I don't think that they would be doing that. So they're expecting about negative $2.7 billion worth of adjusted EBITDA. And I think we can use that as a pretty reasonable proxy for operating cash flow for the year. On top of that, you have $5 billion that's needed to build out the R2 plant in Georgia. That's not going to open until at least 2026. So you can pretty easily get to the point where Rivian starts to run out of cash before the end of 2026. Now remember, the stock price is falling down about 90% from its peak, and that market cap is only about $10 billion. So let's say that they need $4 or $5 billion to get to the point where they can build out the Georgia plant and ramp up production. That's going to take a year or two to do that based on what we've learned from their R1 ramp. Well, where are they going to come up with that cash? They've got $4.4 billion worth of debt. Like I said, high interest rate. So that's probably not going to happen. They're going to have to sell stock. So what's the stock going to do in response? This is that downward spiral that I was talking about. And now we bring into the fact that Tesla is starting to lower prices even more in China. I think that price war will continue in the US. So now you're looking at potentially building an R2 plant that's going to be a vehicle that's going to be more directly competing with some of the existing crossover type vehicles and cars that are available today. Now you're going to have a lower price point because you're competing directly with something like the Model Y, which has had price cuts over the last 2 years. It's not really clear that that's going to ultimately be a profitable vehicle. So this is the downward spiral that I'm talking about. Let's look at Lucid next. Lucid is a very similar story to Rivian. Stock price is down over 90% from its peak. The market cap right now, as I'm recording, is about $7.3 billion. And you can see this cash position is just getting worse and worse year after year. Not only is cash dwindling, but they also have debt on the balance sheet. And what does free cash flow look like? Negative $3.4 billion in the last year. Now, Lucid has a number of different challenges from Rivian. They don't have quite the same manufacturing growth plans, but they're trying to break into the high-end market, sell vehicles for $80,000, $90,000, $100,000. And that's a really small segment of people who can afford those kinds of vehicles and want those kinds of vehicles. And that's exactly what we've seen from their operations over the last few quarters, is they're just simply not selling everything that they can make right now. Those losses are mounting. Free cash flow is getting worse. And I think really the only optimism that investors could have right now is that this company is eventually going to get bailed out by Saudi Arabia, who owns most of the company as it is today. I don't know that that's necessarily going to be the case. And from a fundamental perspective, it's hard to like their operations at all. So this is another company that's clearly in a downward spiral. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. I can't reiterate enough that these are fundamentally manufacturing companies. We like to think about a lot of these companies as technology companies, but that's not the case. They're building manufacturing plants. They're putting equipment in them. They're hiring workers to build vehicles. They're buying steel and batteries. They have all of the characteristics of a manufacturing company. And that means that they live by the laws of supply and demand like every other manufacturing company. And right now, it seems like demand is not growing at nearly the rate that the industry thought, that a lot of these manufacturers thought. That's resulted in prices coming down, sales growth slowing, and what you're seeing in the manifestation of that is the price war that we're seeing happening both in the US and also in China. The Chinese news today was just the latest example of that. But this is something that's been happening around the world. Now, the difference with Tesla is that Tesla is going to be coming from a much better position of strength. They've had positive free cash flow the last few years. They're sitting on a very good balance sheet. They have strong margins. So all those charts that I showed earlier that show the weakness of companies like Rivian and Lucid are going to look very different for Tesla. But the challenge for Tesla is going to come more from a valuation perspective. Now, this is a look at Tesla's valuation. And there's a lot of information in this chart, but I'll go through the numbers. The market cap for Tesla right now is $645 billion as I'm recording. Price to sales multiple is 6.5. Price to earnings multiple on a trailing basis is 47. Price to earnings multiple on a forward basis, which actually incorporates analyst estimates for next year, is actually 63. So what that indicates is that investors think that profits are going to be lower in 2024 than they were in 2023. So keep that in mind, that expectations are falling for Tesla, not rising. So the reason this is a risk for Tesla is legacy automakers who have much more established businesses, who actually haven't had the same decline in margins that Tesla has had over the last year or so, they actually trade for multiples that are about 1/10 of what Tesla is trading for. Price to earnings multiple for companies like GM and Ford is hovering between 4 and about 6 or 7, depending on the quarter. So these are very, very low value companies. Price to sales multiple is typically more like 0.2 or 0.3. So the risk for Tesla is that this becomes a company that trades not like a technology company, but more like a traditional auto company. Maybe Tesla deserves a little bit of a premium multiple. Maybe it deserves a 10 price to earnings multiple, but that indicates that the stock's going to fall 80% or so from here, maybe even more than that based on next year's estimates. So this is the risk for Tesla. It doesn't have the viability risk that a company like Rivian or Lucid has, but you have a ton of valuation risk with Tesla. Something I've been covering for a long time on this channel, but if you look at the trends, the margin trends for Tesla and the sales trends and what the company's had to do to respond to manufacturers, this is a company that's acting a lot like an auto manufacturer, not like a technology company. That should be a warning for investors to not pay too much for Tesla stock. And given the current valuation, I think it's hard to argue that this is anything but a very overvalued stock right now. So a lot of news happening in the electric vehicle space, but this price war that Tesla is involved in is going to drag every other company along with it. And the worry that investors should have from an EV perspective is that it's going to drag operations and ultimately valuations along with it. And I think there's a lot of downward potential for a lot of these stocks. I think every single EV stock right now is still overvalued, even though some of them are down over 90%. But what do you think about EV stocks? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.